Welcome to the Markets Happy Hour podcast, a weekly markets update for investors the world over. Each week we discuss inflation, geopolitics, interest rates, equity markets, and other asset classes. To try to answer the question, what does this mean for my investment portfolio? Let's dive in.
One of the comments I've been kind of focused on that I've seen come out is how some of the stocks have moved, just the sizable moves in certain stocks. So even though we will be finishing November essentially flat, to see some of the large moves, not only in tech stocks, but also in, say, retail stocks. Urban Outfitters was up 17% today based on positive sales data. We can see Eli Lilly has done well based on, again, GLP-1 developments there. So still quite a bit of individual stock volatility. And we've been discussing concentration for some time. Do you have given you look broadly across markets and across the history, does this concentration, some of this individual stock volatility, how do you kind of frame that for your clients and in the advice you give?
I think the concentration is certainly something that has to be front of mind for investors right now. It's driven the bull market very, very high, but essentially we're getting to a point where we're seeing two different markets operating in the same room, as it were, in the United States, where you've got these mega cap, highly tech exposed stocks that are kind of driving everything upwards. And any move in those stocks is driving moves in the entire index to a greater and greater extent, with, the top 10 stocks in the Morningstar US large mid cap index, which is roughly parallel to the S&P 500, is around 39% concentration in those top 10 stocks. So you're looking at really, really big moves in very, very popular trades that are moving indexes. And so we're encouraging people to think a bit more broadly. The small cap and mid cap areas of the market haven't really been exposed to those massive moves in quite the same way. And so we think there are pockets of good value in there that investors need to be thinking about for the long term, because at these current valuations, we don't necessarily think that they are sustainable over the long term and going to drive the long-term returns that people are expecting that are implied by the current prices. So there really is a need to start to show discernment and look for value in a much wider range of spaces.
Another perfect leg up to the next slide, which is around some of this discernment that you mentioned. The picky eaters I've described, investors becoming we know all about that at the Thanksgiving or Christmas table, but it seems that there is actually a real ability to sort of look at maybe perhaps a dispersion between winners and losers, early adopters, perhaps followers that will be able to gain market share, a sense that the AI trade is splintering as Google is challenging NVIDIA's dominance. That was very easy to see if we look at the left chart where we show the divergence in stock price performance between Alphabet and NVIDIA. Just in this month, quite a stark dispersion there. One probably benefiting from the fact that it probably was underestimated and overlooked Google's AI prowess. The fact that Google has significant cash flows to fund its AI investment, and then just got quite a bit of excitement around its recent Gemini 3, and then NVIDIA, of course, coming off some of its initial hype and this $5 trillion valuation. Although it is notable that Alphabet is heading towards a $4 trillion valuation of its own. So quite significant dispersion, and certainly that's contributing greatly to its profitability when it comes to Google. So I suppose here, getting again to this market cap question, it's kind of a similar thing to the question about concentration. But when we have market caps of individual companies that dwarf that of entire countries, again, do you think this just means that clients have to think about their equity allocation as having a different kind of risk profile?
They certainly do, Ethan. I think what is unique about this particular situation we're in compared with eras in which we've had concentration before is that these giants are now so big that the average active manager would not necessarily be permitted to replicate that kind of concentration in their own funds. Having 30 or 40% of their equity allocation in just 7 stocks wouldn't necessarily pass a risk committee's approval. So they're really, really having to think about how are they going to beat the market when the strongest performers in the market are so huge. It's a tricky allocation problem for those who are having to make those decisions right now.